Just kind of a brief market update. I actually don't like market updates because they're so, I don't know, unuseful. And typically they either scare people or they worry about it. When you're watching the news, some of the best financial advice I can give you is don't watch the news too much and kind of ignore it, because it tends to, it doesn't do anything good for you really. But having said that, this year is, as far as the market goes, it's been a good year. Of course, we've got our disclaimers anytime we speak. So the S&P is up right about 12% year to date. In April, it was down, it had dipped, but it's recovered since then. If we look at the international stocks, they're actually up around 25%. So it's done surprisingly well. In the past, it had been lagging, and so it's kind of caught up. But that's kind of some impressive growth there. Something that I wanted to point out is the difference between publicly traded securities and private equity. Now, most people, by far, their investment accounts consist of publicly traded securities, right? Or real estate. But it only represents about 25% of large substantial businesses just in the United States. There's a lot more companies that are privately held that have never gone public. And private equity, it's typically been really large hedge funds or large institutions that have invested in them, because there's liquidity issues, there's how do you get diversified, and there's all these challenges. So most Americans have never really invested in private equity, but private equity has performed just extremely well, much better than the public. And that if you look at the trend, 2010 was about $3 trillion in private equity. It doubled by 2018. Now in 2023, it doubled again. And it's on track to almost double again by 2029. So more and more people are investing into private equity. And the key reason behind that is not just because it's done well historically, but because there's more access. So nowadays, there are what's called interval funds, where these large private equity firms have built in enough cash to solve the liquidity problem. So now, while the public stock market is highly liquid, on any given day you can sell to cash, right? Because there's always buyers. The private is not that way. And so where do you get a buyer have ownership in a private company? And they have to either sell the company or you have a private buyer, and it's a much more difficult thing, right? So nowadays, with this built in, with these interval funds, liquidity is generally quarterly. So on a quarterly basis, you can sell your position. So you're not going to have daily liquidity, but quarterly is what we consider, that's highly liquid. Anything under 12 months is really considered liquid. And so now we can actually own a diversified portfolio of a lot of different private equity companies. So we solve the diversification problem and the liquidity problem. And now the average American can actually invest some portion of their money into private equity. And if we look, this is looking at 30 years, private equity has been a very strong performer. It's kind of a well-known thing. And the other thing we like about it is that it doesn't fluctuate as much. So the news, something happens in our world, and the market can just drop, right? We can see it do these sharp drops and coming in, up and down. You don't see that type of fluctuation. There could still be some fluctuation, but if, let's say, something bad happened and you wanted to panic, and so you go to sell it, well, you might have to wait 3 months to sell. So you just don't have the volume. You don't have the day traders and all that's going on. And so it makes for a more stable and diversified portfolio. The other thing is private credit. So that we're talking fixed income here. So think in terms of bonds that are bought and sold on the public market. A significant trend of more and more money being moved into private equity or private credit as well. And it tends to be higher yielding, default rates extremely low. You don't get the buying and selling, and it works quite well. And if we look at kind of a comparison, 10 years, 15 years, 20 years, I mean, private credit is the highest yielding. And so, again, access to private credit is kind of the same thing. We have access now where it was more difficult in the past. The other thing is we can invest right into real estate, right within a retirement account. So if you wanted some of your assets, it could be a small portion, just for the fact that it's different than the rest of your portfolio. And real estate has been, typically a good hedge against inflation, and you don't see when there's recessions, real estate doesn't typically drop the same as the market. I mean, if we look at 2008, of course, there's a lot of loss in real estate during the mortgage crisis. But generally speaking, on average, when the markets are down, real estate is not. So it's different, and we like different. So we want different types of asset classes, and that's what really builds a stable portfolio. As far as the economic outlook, there's really a lot of mixed signals. There's a lot of positive things we can point to. There's things that are questionable and concerning. And so everyone's kind of saying, well, it's really kind of hard to tell. But generally speaking, we're confidently optimistic that things will have a good year. Of course, the Fed has, after a long time, they did make a cut, and they are anticipating making more cuts, even though inflation's a little bit sticking around. So a lot of people are anxious for that to happen, and that will help the market and home buyers and others. Just another real quick update based on our new tax law that just happened this year. It made the tax rates that were set to expire and sunset, and our taxes were going to go up, they were made permanent, so that didn't happen. But then there was also some additional deductions. Specifically, the biggest one here really is for people age 65 or older. So if you're an individual, you have an additional $6,000 of a deduction. Married couples get double that. Now, there are some income phase-out limits, so if your income surpasses these limits, you may not get the full deduction, and maybe none of it, depending on how high your income is. But so now, these new deductions, the senior deduction, actually phases out after 4 years. So it will take a future administration, future Congress to either make them permanent or whatever, because they are set to expire. So here's just to kind of show you, if you're under 65 and you're single, your standard deduction is $15,750. So when you hit 65, there's an additional $2,000, and that was part of the old law that was already there. And now there's the new $6,000 if you're 65 on top of that. So that's $23,750 that, another way of saying that is the first $23,750 that you earn that would be normally taxed is not taxed up to that amount. And then the taxes kick in after that, right? And then here's for a married couple, $31,500. They get an actually $3,200, and then the $12,000 for a total of $46,700. Taxes are historically low. There's no question about it. So we see this as kind of as a window of opportunity to potentially, especially if we've done most of our saving in tax-deferred retirement accounts, to get some of that shifted over into tax-free with some proactive tax planning, Roth conversions, etc. And because we don't know the future. The future, we try to predict. It's hard. It's very difficult to predict, right? With our national debt, which is unprecedented amount, the interest of loans over $1 trillion a year, and then the big thing that I think is going to surprise some people is it's just the aging population and the shrinking workforce. So that demographic change over time is going to put a lot of pressure. And so we just think there's a risk that taxes will likely be shifted up higher at some point. And so we think this is kind of a window of opportunity to potentially get some of your money in tax-free vehicles. Another thing, if you're a business owner, the 20% qualified business income deduction, if your business is, it's not for C Corps, but if you're LLCs, sole proprietors, where you have a pass-through entity, there's that 20% deduction there that was set to expire. So the new law made that permanent. So that's a pretty significant deal for business owners. And then that's about all we wanted to say. Of course, we have our 5 pillars, the 5 key areas. We call it the 5W, 5 areas of wealth that we take into our planning. So the whole picture: income planning, investment planning, tax planning, investment planning, or healthcare, and estate planning as well. We have a very specific process that we go through here and address all the issues to create as an efficient plan as possible. And ultimately, we have a financial house with a foundation that's got an income plan. We've got the walls with the various types of investments, and protection, which includes long-term care planning, estate planning, etc. So that's the little my song and dance. And are there any questions about anything? Yes.
What if one person is over 65 and the other one is under? Do they just get the one?
That's right.
As a single?
That's right. Yep. Yeah, there's a lot of people in that situation that I know right now. Wow.
Didn't they stop taxing Social Security payouts also?
No, they were trying to. The goal was, I know Trump really wanted to eliminate tax on Social Security benefits. In the Senate, they threw that out. Instead, they did this deduction. So for 88% of the people, they essentially will have no tax on their Social Security, so the vast majority. But you still have to do the tax calculation. Nothing changed with the Social Security tax. And so the senior deduction only kicks in at 65. So if you have someone starting Social Security at 62, there's 3 years that's fully taxed. And then depending on their situation, and their income, they may be fully taxed on it anyway. But there is a large deduction where it erases it from most people. Yeah.
Lane, private sector investments, is that a long-term play, like over time, hold for 10 years?
No, that's the beauty. It's 3 months would be the minimum. Yeah, so you could liquidate a position after 3 months, and it's pretty much in 3-month intervals when you could get out or get in. And you typically get in on a monthly basis, but to get out, it's typically going to be quarterly. So, yeah, so it's really a game changer. Just more access to a lot more companies, a lot more diversification, and we think it's a good thing. So, yeah.
The 401 or on the private equity funds, I understand that maybe 401k managers are going to be able to start buying into that more so than they ever have, or is that something new or planning for?
Yeah, that's a good question. So there was an executive order that Trump did this year that said, hey, we want to allow private equity inside of 401k plans. So that was a huge change. There's no I don't think there's any 401k plans yet at all who have actually, first off, they don't have to do it. They can decide. It just means they could do it if they wanted to. So you've got to get each company that's offering a 401k plan to decide that, to embrace it. What private equity are they going to include or not? So it's something in the future that the idea is that there will be some of that available in 401k plans, but right now it's still not there. But if you can get money into any other type of account, IRAs, brokerage account, then we have access to that.
Well, I guess if the 401ks jump into this, will that kind of bring the returns down, or will the returns stay the same with the private equity? There's just
Historically, the returns have been better. Yeah. We don't see it as sacrificing.
diluted or anything like that, or
No, I think it stabilizes it. I think based on historical performance, we can't predict the future, but it makes sense based on the past and the way it's positioned, it will actually do better with less volatility. That's all I got, folks. Really appreciate you coming.